your safe deposit boxes are not covered. In the end, it's still all dog crap. There's 10 ounces of silver for every 1 ounce of gold. So that's God's ratio, 10 to 1. And man's ratio is 80 to 1. One of them is right and one of them is wrong. And I would bet on God rather than man. Your gold, you have your silver before the failure to deliver happens, or you're never, ever going to have it.
Are you ready to witness one of the most extraordinary surges in the history of precious metals? According to renowned financial analyst Bill Holter, the current rally in silver is just the beginning. Holter boldly predicts that silver could skyrocket to an astonishing $3,000 per ounce. Yes, you heard that right, $3,000. This incredible forecast isn't based on mere speculation. It's backed by a deep analysis of market trends, economic indicators, and the shifting dynamics in the precious metals market. Stay tuned as we dive into the factors fueling this potential explosion in silver prices and what it means for investors and the global economy. Could this be the opportunity of a lifetime? Keep watching to find out.
The physical markets are now beginning to negate the paper markets. Go back to October, November of last year, and that's when the moves in the metals started. And they really went into gear the end of February, early March. That in gold, the big buyer has been China. You're also seeing pretty good buying out of Europe. In silver, the huge buying is coming out of India. And both metals got pretty overbought in early mid-April. We had a pretty good, decent-sized pullback. The prices relaxed, and the gold nor silver were overbought. And then just in the last a week and a half or so, you started to see some strength. And I picked up on the article that I posted. I posted 3 charts: gold, silver, and the miners. I used the HUI index. And what you'll see is that the HUI has gotten to the point of close to breakout. It's breaking out at this point. Over 275 is a breakout. Obviously, over silver is a breakout. And those aren't new highs until we get to $50. But there's really nothing on the chart between $30 and $50. So once we get over 30, I think 30 is going to become the floor. And you probably, I'm guessing within 3 to 6 months' time, you'll see $50 in silver. And of course, gold is again pushing up against 2,400. Over 2425 is a new high. If you look at the charts that I posted, you can see on the very bottom of the chart, you see the MACD, that's the moving average convergence divergence. And if you look at the very current time, you'll see on all 3 charts, you'll see a hook that's forming, and the HUI and silver have crossed over, and gold is lagging just a little. The hook is not fully completed, but we've got a crossover in silver and the HUI, and that's going to create momentum buying in silver, gold, and the HUI, and that'll push these things into new highs. And yes, we're going to see huge volatility, but the paper markets no longer rule the price as they have in the past.
In recent months, the precious metals market has been experiencing a remarkable surge, capturing the attention of investors and analysts worldwide. Silver, in particular, has shown impressive gains, challenging previous price ceilings and setting the stage for what could be a historic rally. The current rally can be attributed to several key factors. Firstly, there's been a significant shift in market dynamics where the physical market for silver is beginning to outweigh the influence of the paper market. Traditionally, paper contracts and futures have largely dictated silver prices, often leading to market manipulation and price suppression. However, the physical market's growing dominance is changing the game. This shift is largely driven by increased physical buying from countries like China and India, where demand for silver is skyrocketing. Secondly, economic uncertainty is playing a major role. The global economy is grappling with the aftermath of the COVID-19 pandemic, supply chain disruptions, and geopolitical tensions. These factors are contributing to a loss of confidence in fiat currencies, prompting investors to seek refuge in safe haven assets like silver and gold. Moreover, inflation fears are escalating. Central banks' aggressive monetary policies, including extensive money printing and low interest rates, have sparked concerns about rising inflation. As a hedge against inflation, silver is becoming increasingly attractive to both individual and institutional investors. Another critical aspect is the renewed interest from retail investors. The rise of investment platforms and social media-driven trading communities has empowered individual investors to participate actively in the silver market. This democratization of investment is injecting new momentum into the silver rally. All these elements are converging to create a potent mix that is driving silver prices higher. But according to Bill Holter, this is merely the beginning. The groundwork has been laid for a potentially monumental climb in silver prices, setting the stage for the next major phase in this precious metals journey. Stay with us as we continue to explore the historical context, underlying economic factors, and expert insights that support this bullish outlook on silver. What lies ahead could redefine the precious metals market as we know it.
The credit market is so key and critical because everything in the world runs on credit. The financial markets are supported by credit. The real economy runs entirely on credit. I mean, if credit goes away, we've talked about this before, store shelves will be empty and they won't be restocked because the wheels of the real economy stop once credit stops. The 10-year Treasury, as you know, interest rates were 1% or lower for many, many years. I don't know, 5, 6, 7 years. Back in, I think it was 2020 or early 2021, the 10-year Treasury got down to 0.6 of 1%. And in the lead up to that, there had been talk about negative interest rates, which we don't have to get into, but they were trying to bring that forward that, oh yeah, we could have negative interest rates and everything will be fine. The problem is if you have negative interest rates, it means everything's worth nothing. And that's we could do a whole interview on that. My point being, we went from 0.6 of a percent to right at 5%, and it only took about 18 months for rates to rise that amount. And of course, that was based on the Fed's tightening, the Fed's raising rates, blah, blah, blah. And once we get to 5%, I mean, that was such a huge move. There was a snapback rally in bonds and yields. As bond prices levitated, the yields came back down to, call it 375. Here we are right now as we speak, we're at 4.7. So we've already wiped out a huge portion of that gain. And at 4.7, I mean, we're sniffing at 5% again. I think I was on the record that anything over 3.25% would start to shake the system. And that obviously happened. You can see it as mortgage rates went up. I mean, look at commercial real estate now. I think across the board, it's not even a grand statement to say that commercial real estate across the board is down 40% or more. And in some cases, much, much more. I mean, look at some of these hotels that have bankrupted because they could not refinance their bonds. They're being offered at 25% of what they were in 2015. So just understand that when interest rates go up, that puts massive pressure on an over-leveraged system. And we got to the point where the most leveraged system in the history of mankind, and rates basically went up, what would that be? 8-fold, 9-fold to 5%. You're looking at over 7% on mortgage rates now. So looking at a house a year and a half, 2 years ago, when you could get 3.5, 3 3/4 on a mortgage, if you qualified for $1 million mortgage, today you only qualify for, say, $600,000. The problem, what that basically means is the buyers have had their legs cut out from under them, and people are stuck. And you've seen a 50% reduction in closings.
These markets.
And just understand, no matter what market it is, price always follows volume.
Investors towards safe haven assets like silver and gold. One of the most notable periods was the late 1970s, a time marked by high inflation and economic uncertainty. During this era, silver prices soared from around $6 per ounce in early 1979 to nearly $50 per ounce by January 1980. This dramatic increase was fueled by a combination of rampant inflation, geopolitical tensions, and significant buying by the Hunt brothers, who attempted to corner the silver market. Although their efforts eventually led to market regulation and a subsequent crash in prices, the spike underscored silver's potential for rapid appreciation in times of economic distress. Another critical period was the early 2000s, following the dot-com bubble burst and the 9/11 terrorist attacks. These events led to widespread economic uncertainty and prompted the Federal Reserve to slash interest rates, leading to concerns about the weakening U.S. dollar. As a result, silver prices began a steady climb, rising from under $5 per ounce in 2001 to nearly $50 per ounce again by 2011. This decade-long rally was driven by fears of inflation, increased industrial demand, and growing investment interest. More recently, the aftermath of the 2008 financial crisis saw a renewed surge in precious metals. In response to the crisis, central banks around the world implemented aggressive monetary policies, including quantitative easing and near-zero interest rates. These measures eroded confidence in fiat currencies and heightened the appeal of silver and gold as stores of value. Silver prices, which had dropped to around $9 per ounce in late 2008, rebounded strongly, peaking at almost $50 per ounce in 2011. Today we are witnessing a similar convergence of factors. Economic recovery from the COVID-19 pandemic remains uncertain, inflation is on the rise, and geopolitical tensions are once again in the spotlight. These conditions are reminiscent of past periods that have led to significant rallies in silver and gold. What sets the current rally apart is the structural shift in market dynamics, with the physical market beginning to dominate over the paper market. This shift, combined with the growing influence of retail investors and technological advancements in trading, suggests that the potential for silver to reach unprecedented highs is more tangible than ever. As we continue to delve into the underlying economic factors and expert insights, it becomes increasingly clear that the current precious metals rally is not an isolated event, but part of a larger historical pattern. Bill Holter's prediction of a $3,000 silver price is grounded in this rich historical context, pointing to a future where silver's value could soar to new heights.
Math. We're at the point now we paid last year over $1 trillion just in interest. That's more than defense spending, and defense spending in the U.S. is greater than all defense spending in the rest of the world. So we're at $1 trillion. By the end of this year, we're going to be at $1.5 trillion, $1.6 trillion. You can't, the math does not work. You can't pay 1.6 trillion in interest on 4.5 trillion in tax inflows. What's happened is the debt has gotten so large that it's crowding out. It's crowding everything else out. It's going to become, if you look at the math, just look at a long-term chart on it. At some point in time, if they kept kicking the can and kicking the can, if markets allowed them to do that, at some point in time, we'd be paying more in interest than we were taking in tax revenues. And it's a mathematical impossibility. So all you have to do is look at the math, the current math, and that's why the can can't get kicked down the road anymore.
Inflation and hyperinflation have historically been powerful drivers of precious metals prices, particularly silver. As we look at the current economic landscape, the parallels to past periods of high inflation are becoming increasingly evident, making the case for silver's potential surge even stronger. Inflation occurs when the prices of goods and services rise, eroding purchasing power. Hyperinflation is an extreme form of inflation, where prices increase uncontrollably, often exceeding 50% per month. In such scenarios, the value of fiat currencies plummets, and people turn to tangible assets like silver and gold to preserve their wealth. A classic example of hyperinflation occurred in Weimar Germany in the early 1920s. Following World War I, Germany faced enormous reparations, which led the government to print vast amounts of money. The resulting hyperinflation caused the price of silver, along with other commodities, to skyrocket as the German mark became virtually worthless. Fast forward to the 1970s, a decade marked by stagflation, a combination of stagnant economic growth and high inflation. During this time, silver prices soared as investors sought refuge from the depreciating dollar. The price of silver, which was around $1.50 per ounce in the early 1970s, surged to nearly $50 per ounce by 1980. In more recent history, the financial crisis of 2008 and the subsequent monetary policies led to fears of inflation. Central banks around the world, particularly the Federal Reserve, implemented quantitative easing and kept interest rates near zero. These actions increased the money supply and raised concerns about future inflation, contributing to a significant rally in silver prices, which peaked at nearly $50 per ounce in 2011. Today, similar economic policies are in play. In response to the COVID-19 pandemic, central banks have once again resorted to aggressive monetary easing. The global money supply has expanded rapidly, and inflation rates are climbing. In the United States, inflation has reached levels not seen in decades, causing widespread concern among investors. This environment is highly conducive to a surge in silver prices. Unlike fiat currencies, silver has intrinsic value and is seen as a reliable store of wealth during times of inflation. As inflation erodes the value of paper money, the demand for silver as a hedge increases. Moreover, the current economic backdrop suggests that hyperinflation, while still unlikely in major economies, cannot be entirely ruled out. The unprecedented levels of debt and the potential for further monetary expansion could push inflation rates even higher, making silver an even more attractive investment. Bill Holter's prediction of silver reaching $3,000 per ounce hinges on these inflationary pressures. As more investors seek to protect their wealth from the depreciating value of fiat currencies, the demand for silver is likely to soar. This, combined with the physical market's growing influence, sets the stage for a potential explosive rally in silver prices. Stay with us as we explore more about market volatility, central bank policies, and other critical factors that could drive silver to new heights.
Failures all over the world. And the bank failures you're seeing now are small potatoes. All you have to do is look at the commercial real estate market. I mean, I just posted an article the other day of the Waldorf Astoria that was owned by Trump. It sold in 2021 for, I think, 137 million. And it just went to auction and sold for 12.5 million. So that's over a 90% drop in value in 3 years' time. But somebody's going to eat those losses because that was debt. It was outstanding. A lot of that was debt. So those bonds have to be written down, and somebody has to eat those losses. And if you look at the banking system, I mean, you're looking at literally $1 trillion of losses in debt, in bonds, in credit that had been forwarded. And of course, keep in mind, the reason these properties went to the prices they went to was because credit was available. And now credit has become much tighter. The underwriting standards are tighter. Interest rates are higher. The math doesn't work. And, one of the primary losers will be the banking system. I wouldn't characterize it as a collapse, but I think maybe the Chinese yuan. Obviously, we're watching the yen right now really hit the skids. But I think the Chinese are going to revalue gold higher. They've got a real problem. Their debt creation actually went negative late last year, and their M1 money supply has just recently gone negative. So you've got a highly indebted system that's staring deflation right in the face. And the best way to fight deflation is through devaluing your currency. So I suspect you're going to see a revaluation of the yuan versus gold, and that will reprice gold higher, the yuan lower, and it will be in managed form, if you will. But that will, to foreign currencies, it's going to look the same thing as a collapse. So if I had to bet, I would bet that China would be the first currency to truly devalue on purpose versus gold, but it devalues them versus foreign currencies, and that'll drag foreign currencies down with them.
Market volatility and the declining trust in fiat currencies are crucial factors contributing to the current and future performance of silver. As investors navigate through these turbulent times, silver's appeal as a stable and secure asset continues to grow. Market volatility refers to the rapid and significant price movements within financial markets. Over the past few years, we have witnessed extraordinary volatility across various asset classes, driven by factors such as geopolitical tensions, economic disruptions from the COVID-19 pandemic, and shifting monetary policies. This instability often leads investors to seek refuge in more stable assets, with silver being a prime choice. One of the main reasons for silver's attractiveness during volatile times is its historical role as a safe haven asset. Unlike stocks or bonds, silver is a tangible asset with intrinsic value, providing a hedge against market turbulence. When equity markets experience sharp declines, as seen during the initial stages of the COVID-19 pandemic, investors flock to silver to preserve their capital. Fiat currencies, on the other hand, are government-issued currencies not backed by a physical commodity like gold or silver. Their value is derived from the trust and confidence that people place in the issuing government. However, this trust can be fragile. When central banks print excessive amounts of money, as they have in response to recent economic crises, the value of fiat currencies can diminish rapidly. Historically, when confidence in fiat currencies wanes, silver and gold tend to perform well. For instance, during the 1970s, high inflation eroded the value of the US dollar, leading to a significant rise in silver prices. Similarly, in the aftermath of the 2008 financial crisis, fears of currency devaluation drove up the demand for precious metals. Today, we are seeing a similar trend. Central banks worldwide are continuing to implement expansive monetary policies, which include maintaining low interest rates and conducting large-scale asset purchases. These measures are intended to stimulate economic growth, but often lead to an increased money supply, fueling inflation fears and reducing confidence in fiat currencies. The US dollar, as the world's primary reserve currency, is particularly influential. Recent data showing rising inflation rates in the US has sparked concerns about the dollar's long-term purchasing power. As a result, more investors are turning to silver and other precious metals to hedge against potential declines in the dollar's value. Moreover, the increasing geopolitical instability adds another layer of uncertainty. Conflicts, trade wars, and political upheaval can all impact investor sentiment and market stability. In such scenarios, silver's role as a safe haven asset becomes even more pronounced. Bill Holter emphasizes that the current market dynamics, characterized by high volatility and declining trust in fiat currencies, are setting the stage for a significant rally in silver prices. As investors seek to protect their wealth from these risks, the demand for silver is expected to rise sharply. Stay with us as we delve into the actions of central banks and government policies, examining how they further influence the precious metals market and support the case for a $3,000 silver price.
That's a good question. And the answer is you're not going to sell gold or silver until there's a currency that you can trust, until there's a place for you to put your money. But we're nowhere near that. We're nowhere near a peak, so to speak. The peak pricing in gold and silver will be, if you want to call it, the bottom pricing on fiat, and fiat ultimately can go to zero. So the inverse of zero is infinity. So I guess my answer is, I would answer the question with the same question: where would you put the money? And if there's no place to put the money, then why would you get out of gold or silver, which you know cannot bankrupt? It can't be devalued. So you sit with the metal until you find a currency that you can trust. I mean, I've been talking about the ratio trade for years and years. Silver is way undervalued to gold, and I urge people to overweight in silver. And at a later date, as the ratio comes down, I mean, here we are at 80. If the ratio came down to 40, that would mean silver doubled the performance of gold. And if you swapped silver for gold at a 40 ratio, you'd end up with twice as many gold ounces than if you just bought them outright today. So you'd be buying gold with you'd be buying less expensive gold with more expensive silver, and you'd end up with more gold.
Central banks and government policies play a pivotal role in shaping the precious metals market, particularly silver. The decisions made by these institutions can significantly impact investor behavior, market dynamics, and ultimately, the price of silver. Central banks are responsible for managing a country's monetary policy, which includes controlling interest rates and regulating the money supply. Over the past decade, central banks around the world have adopted extremely accommodative monetary policies to combat economic slowdowns and stimulate growth. These policies have included maintaining historically low interest rates and engaging in large-scale asset purchases, known as quantitative easing, QE. Quantitative easing involves central banks purchasing government bonds and other financial assets to inject liquidity into the economy. While this approach aims to boost spending and investment, it also leads to an increase in the money supply, which can devalue fiat currencies and fuel inflation. As the value of paper money diminishes, investors often seek out assets that retain value, such as silver and gold. The Federal Reserve, the European Central Bank, and other major central banks have continued these policies in response to the economic fallout from the COVID-19 pandemic. The massive expansion of central bank balance sheets has led to growing concerns about inflation and the long-term sustainability of fiat currencies. These concerns drive demand for silver as a hedge against currency devaluation and inflation. In addition to monetary policy, government fiscal policies also impact the precious metals market. Large-scale government spending, financed by borrowing and increased money printing, exacerbates fears of inflation and weakens confidence in fiat currencies. For example, the significant fiscal stimulus packages rolled out by governments worldwide to mitigate the economic effects of the pandemic have contributed to higher debt levels and increased the risk of future inflation. Moreover, geopolitical events and government regulations can influence silver prices. Trade tensions, sanctions, and political instability can disrupt markets and create uncertainty, prompting investors to move their capital into safer assets like silver. For instance, the trade war between the United States and China has led to increased market volatility and uncertainty, bolstering the appeal of precious metals. Central banks themselves are also significant players in the precious metals market. Some central banks, particularly those in emerging markets, have been increasing their gold reserves as a means of diversifying their assets and reducing reliance on the US dollar. While silver is not typically held in central bank reserves to the same extent as gold, the overall trend of increasing precious metal holdings underscores the growing recognition of their value as safe haven assets. Bill Holter points out that these ongoing central bank policies and government actions are creating a perfect storm for silver prices to surge. The relentless expansion of the money supply, coupled with rising inflation fears and geopolitical uncertainties, sets the stage for a significant rally in silver. Holter's prediction of a $3,000 silver price is rooted in the belief that these macroeconomic factors will continue to drive investors towards precious metals. Stay with us as we explore the growing demand for silver from emerging markets, technological advancements, and industrial uses, which further strengthen the case for a monumental rise in silver prices.
All I can tell you is I've read the footnotes to the Great Taking. Those are actual laws that are in place. And when you deposit funds into a broker or you deposit funds into a bank, it's not a deposit. You're loaning the bank or you're loaning the broker your money, and you become a creditor. And your standing as a creditor is below, far below, the senior creditors. The senior creditors, and this, without getting way into it, it has to do with derivatives, and that's where what this is all about. The collateral is like a lamb ready to be slaughtered by derivatives blowing up. If derivatives, or when derivatives blow up, then collateral is going to have to be given from the loser to the winner. And that collateral just so happens to be your capital, or what was your capital. And there's actually, it's an interesting thought process between collateral and derivatives. Has collateral been pooled to support the derivatives edifice, or were derivatives created to steal the collateral? And in my personal opinion, I think this was known years ago when they started, if you want to call it derivatizing, not only the financial markets, but all markets. When they started to create derivatives, I think they had this ending in mind, that the derivatives would get so big that one side would lose, the other side would win, but the loser would lose so badly that they would be bankrupt. They'd be upside down insolvent, and they'd have to turn their collateral over. So to me, in my opinion, I think this was the plan all along, is that the derivatives are the mechanism to take everything. And don't forget, you've got Klaus Schwab running around saying, you will own nothing and be happy. Well, now we know how the you will own nothing part happens. The you will be happy, who knows? Maybe they're dropping happy dust out of the chemtrails. Maybe it's something in the water. I have no idea. But when he says you will own nothing and be happy, we know how the you will own nothing part is going to happen.
The growing demand for silver from emerging markets is a critical factor driving the current rally and supporting the potential for a significant increase in prices. Countries like China and India are at the forefront of this surge in demand, and their influence on the global silver market cannot be overstated. China, the world's second-largest economy, has been steadily increasing its silver imports. This demand is driven by multiple factors, including industrial use, jewelry, and investment. Silver is a crucial component in various high-tech industries, such as electronics, solar energy, and electric vehicles, all of which are rapidly expanding in China. The country's commitment to green energy initiatives, including the massive deployment of solar panels, has significantly boosted its silver consumption. In addition to industrial demand, Chinese investors are turning to silver as a store of value amidst economic uncertainty and concerns about the stability of fiat currencies. The Chinese government's encouragement of precious metal ownership among its citizens further supports this trend. As a result, China has become a major player in the physical silver market, contributing to the upward pressure on prices. India, another emerging market powerhouse, has also seen a remarkable increase in silver demand. Traditionally, India has been a significant consumer of gold, particularly for jewelry and investment. However, in recent years, silver has gained popularity due to its affordability and similar properties as a store of value. Indian investors and consumers are purchasing silver in large quantities, driven by cultural preferences and economic considerations. The Indian solar industry, like China's, is expanding rapidly, contributing to higher industrial demand for silver. India's ambitious renewable energy targets include significant investments in solar power, where silver plays a crucial role in photovoltaic cells. This industrial demand is expected to grow steadily, further bolstering the case for rising silver prices. Moreover, the overall economic growth in emerging markets leads to increased disposable incomes, allowing more individuals to invest in silver. As these economies continue to develop, the middle class expands, and with it, the appetite for precious metals as a means of wealth preservation and investment. Bill Holter emphasizes that the demand from these emerging markets is a game changer for the global silver market. The combination of industrial, investment, and cultural factors driving silver consumption in China and India creates a robust foundation for sustained price increases. As these countries continue to grow and their demand for silver intensifies, the global supply will face increased pressure, leading to higher prices. The physical silver market's dominance over the paper market is further reinforced by this surge in demand from emerging markets. Unlike paper contracts, which can be manipulated and do not require actual delivery of silver, physical demand necessitates the real metal. This growing preference for physical silver in emerging markets is gradually shifting the market dynamics, reducing the influence of paper trading on price discovery. Stay with us as we delve into the technological and industrial uses of silver, and how these advancements are expected to drive future demand and support Bill Holter's prediction of a $3,000 silver price.
China, since 2008, anytime the world, it looked like there was going to be a slowdown or an actual deflation, China would reflate. And a devaluation of the yuan, that would be a reflation act. China's national debt on a percentage basis, I don't believe is as high as the U.S., but their total debt, when you include the provinces, the cities, corporate debt, individual debt, they've got a debt problem. Right now, China is considering buying up literally millions of empty homes to try to clean up that real estate market. So it looks to me like something's going to happen in short order. And I think that's something that's going to happen is China's going to devalue.
Silver's unique properties make it indispensable in a wide range of technological and industrial applications. As technological advancements continue to evolve, the demand for silver is expected to rise, further supporting the bullish outlook on its price. Understanding these uses is crucial to grasping why silver is poised for significant gains. One of the most prominent applications of silver is in the solar energy industry. Silver is a critical component in photovoltaic (PV) cells, which are used in solar panels to convert sunlight into electricity. The conductive properties of silver make it an ideal material for enhancing the efficiency of PV cells. As countries around the world, including major economies like China and India, invest heavily in renewable energy sources to combat climate change, the demand for solar panels, and consequently silver, is set to soar. The electric vehicle (EV) industry is another major driver of silver demand. Silver is used in various components of electric vehicles, including batteries, connectors, and control units, due to its excellent electrical conductivity and durability. As the global transition to electric mobility accelerates, the need for these components will increase, boosting silver consumption. Governments worldwide are pushing for greener transportation solutions, with many setting ambitious targets for EV adoption. This shift promises to create a significant and sustained demand for silver. Beyond renewable energy and electric vehicles, silver is vital in the electronics industry. Its superior conductive properties make it essential for manufacturing various electronic devices, such as smartphones, computers, and televisions. With the ongoing advancements in technology and the proliferation of electronic devices, the demand for silver in this sector is expected to remain robust. Medical applications also contribute to silver's demand. Silver's antibacterial properties make it valuable in healthcare settings for wound dressings, medical devices, and coatings that prevent infection. The medical industry's reliance on silver for its antimicrobial benefits underscores the metal's versatility and essential role in modern medicine. Additionally, silver is used in various other industries, including water purification, chemical production, and photography. While these applications might not be as significant as those in renewable energy, electronics, or healthcare, they collectively add to the overall demand for silver. Bill Holter points out that these diverse and growing industrial uses of silver create a solid foundation for its future price appreciation. Unlike gold, which is primarily used for investment in jewelry, silver's industrial applications ensure a steady and increasing demand. This industrial demand, combined with investment demand driven by economic uncertainty, inflation fears, and declining trust in fiat currencies, sets the stage for a significant rally in silver prices. The increasing dominance of the physical market over the paper market further amplifies the impact of industrial demand on silver prices. As more industries rely on silver for their technological advancements, the physical supply of silver becomes increasingly constrained, driving prices higher. Stay with us as we explore asset protection strategies involving silver and how integrating silver into retirement planning can safeguard against economic uncertainties, further supporting the case for a $3,000 silver price.
Credit runs everything. Credit supports the markets. Understand that credit has been used to sell paper gold and paper silver short. Doesn't mean that there's gold or silver behind it, but credit was used and has been and is being used to suppress the prices. So when the great margin call arrives, those sellers are going to be forced to buy. As far as gold and silver, it turns out that the big, huge buying is being done in Asia. It's being done on the Shanghai exchange. They do have paper contracts. They are buying contracts. They're buying physical. I just got something this morning. The Shanghai silver inventories are down 60% year over year. Last night, another 2.5% were withdrawn. So the amount of silver in Shanghai has dropped by more than 50%. If you go look at the first quarter for India, India traditionally has been a big buyer of gold. They bought more silver in the first quarter than they had ever. Actually, they bought more more silver in March than they had in any quarter. And they're buying their pace of buying is somewhere around 30% of global production. So the Indians are gobbling up silver, not paper contracts. They're buying physical silver. And we're at the point now, and I'm on the record probably at least 10 years now, that ultimately when this ends, it will be a failure to deliver. And when there's a failure to deliver, whatever price you're quoted or see, it's complete bullshit, because at that point there's no metal, there's no way to determine a price. So what I'm saying is gold and silver under a scenario, and this is not speculation either, there will be a failure to deliver because the paper system keeps getting bigger, yet the above ground supply is only growing by 1.5% per year. So the paper system is going to gobble up every single ounce available of gold, of silver. There won't be any available, and there will not be a way to price it. So
as economic uncertainties loom, integrating silver into asset protection strategies and retirement planning is becoming increasingly popular among investors. Silver's unique properties make it a valuable asset for safeguarding wealth against inflation, market volatility, and currency devaluation. One of the key strategies for protecting retirement assets is diversification. Diversifying your investment portfolio by including a mix of stocks, bonds, real estate, and precious metals can help mitigate risks. Silver, with its dual role as both an industrial commodity and a monetary metal, offers unique diversification benefits. It not only acts as a hedge against inflation and currency depreciation, but also benefits from industrial demand. Trusts and other legal instruments are crucial in asset protection strategies. Establishing trusts can help manage and distribute your assets according to your wishes, while providing potential tax advantages and shielding assets from creditors. Including silver in these trusts can add an extra layer of protection. Trusts can hold physical silver or silver-backed assets, ensuring that a portion of your wealth is preserved in a tangible, appreciating asset. Offshore trusts and accounts are another avenue for protecting assets. By diversifying your holdings across different regions, you can protect your retirement funds from local economic and political instability. Offshore trusts can include investments in physical silver, benefiting from the metal's global demand and limited supply. Annuities and insurance policies also play a vital role in protecting retirement assets. Annuities can offer guaranteed lifetime income and protect your principal from market volatility. Including silver as part of the investment mix in an annuity can provide additional security. Similarly, specific insurance policies, such as long-term care and disability insurance, can prevent your assets from being depleted due to unexpected health events. Roth IRAs are another effective tool for asset protection. Roth IRAs offer tax advantages and, in many cases, protection from creditors. By holding silver within a Roth IRA, investors can benefit from both the tax-free growth of their investment and the asset protection features of the account. This combination makes silver an attractive option for retirement savings. Regular reviews and adjustments of your asset protection plan are essential. As market conditions change, it's crucial to reassess your portfolio and make necessary adjustments. Keeping a portion of your retirement assets in silver ensures that your wealth is protected against unforeseen economic shifts and inflationary pressures. Bill Holter's prediction of a $3,000 silver price highlights the importance of including silver in retirement planning. As inflation rates rise and economic uncertainties persist, the value of fiat currencies may decline, eroding the purchasing power of traditional retirement savings. Silver, with its historical performance as a hedge against inflation, provides a reliable store of value, ensuring that your retirement funds maintain their worth over time. The physical nature of silver also adds to its appeal for asset protection. Unlike paper assets, physical silver cannot be easily devalued or manipulated by financial institutions. This tangible quality provides a sense of security, knowing that a portion of your wealth is held in a real physical asset. As we continue to explore the expert opinions and predictions supporting the case for a $3,000 silver price, it's clear that integrating silver into asset protection and retirement planning strategies is a prudent move. Silver offers a unique combination of security, diversification, and growth potential, making it an essential component of a robust financial plan. Stay with us as we delve into the insights of various experts, including Bill Holter, to understand why they believe silver is set for a monumental rise and how you can position yourself to benefit from this potential surge.
Well, I mean, just go back to the 1930s when banks went under. People went into the bank after it reopened and their safe deposit box was empty. And I mean, the law is already clear on that. If a bank goes under, they can pilfer your box and don't expect anything to be there. So the name safe or safety deposit box, it's not safe. If you put gold or silver into your safe deposit box, you're better off just dumping it out in your backyard. You probably have a better chance of not having it stolen. The other thing, you talked about the 3 to 5 years to make people whole. Okay, so you feel good that you're going to get your 250,000 or whatever under that back. The problem is, in 3 to 5 years, the currency will have gone to zero. So you'll get 250,000 nothings, if you will, because remember, the dollar, the euro, the yen, all of these currencies are supported by debt. They're supported by credit. And when credit fails, and it's going to fail, and we might talk about the 10-year bond after this, but credit is going to fail. And when it does and collapses in a domino effect, then the currencies themselves become worthless. They lose value once the credit loses value. So, if you feel good because you've got FDIC insurance, and by their own admission in writing, they can take up to 3 to 5 years to pay you. By the time you get your dollars or your capital, it's going to be worthless anyway.
As we examine the future of silver, it's essential to consider the insights and predictions of various experts in the field. Bill Holter is not alone in his bullish outlook on silver. Many renowned analysts and financial experts share his perspective and provide compelling arguments for why silver is poised for a monumental rise. One such expert is Mike Maloney, a well-known precious metals advisor and the author of Guide to Investing in Gold and Silver. Maloney has long been an advocate for investing in silver, highlighting its historical role as money and its potential for massive gains in the face of economic instability. He argues that silver is significantly undervalued compared to gold, and as the market corrects this imbalance, silver prices could see substantial increases. David Morgan, another respected voice in the precious metals community and the founder of the Morgan Report, also sees a bright future for silver. Morgan emphasizes the growing industrial demand for silver, particularly in green technologies and electronics. He believes that this demand, coupled with the limited supply of silver, will drive prices higher. Morgan has projected that silver could reach $100 per ounce in the next few years, and potentially higher if economic conditions deteriorate. Rick Rule, a seasoned investor and former president and CEO of Sprott U.S. Holdings, has consistently highlighted the investment potential of silver. Rule points out that during previous bull markets, silver has outperformed gold due to its smaller market size and higher volatility. He expects a similar pattern to emerge in the current market cycle, with silver prices rising more sharply than gold as investor interest grows. Jim Rickards, an economist, investment banker, and author of The New Case for Gold, also sees significant upside for silver. Rickards notes that silver, like gold, benefits from being a safe haven asset during times of economic uncertainty. He suggests that as central banks continue to debase currencies through aggressive monetary policies, silver will become increasingly attractive to investors seeking to preserve their wealth. Bill Holter's prediction of a $3,000 silver price might seem extraordinary, but it's grounded in a thorough analysis of these factors. Holter emphasizes that the convergence of inflation, currency devaluation, market volatility, and industrial demand creates a perfect storm for silver. He argues that the physical silver market's growing dominance over the paper market will amplify these effects, leading to a significant price surge. Holter also highlights the potential for a reset in the global financial system. He believes that as confidence in fiat currencies erodes, there will be a shift towards tangible assets like silver and gold. This shift could be accelerated by geopolitical events, economic crises, or policy changes, all of which have historically driven investors towards precious metals. The collective insights of these experts paint a compelling picture of silver's future. They agree that the current economic environment is highly conducive to a significant rise in silver prices. The combination of rising industrial demand, inflationary pressures, and a potential loss of confidence in fiat currencies creates a strong case for investing in silver. As we approach the final steps in our exploration of silver's potential, it's clear that integrating these expert opinions into your investment strategy can provide valuable guidance. The consensus among these seasoned analysts is that silver is poised for substantial gains, and positioning yourself to benefit from this trend could be a wise financial move. Stay with us as we discuss the potential risks and considerations for silver investors, ensuring you have a comprehensive understanding of the market before making any investment decisions.
33 gold, I mean, in law, they are considered collectibles. And if there was a confiscation of bullion, those would not be affected because they're not bullion, they're collectibles. Going one notch down the totem pole would be eagles. Those should give you some protection against confiscation because it would be very difficult for the mint to sell you an eagle today and then next week demand that you sell it back to them. They did it in 1933-34, and it was they could do it because it was the money of the realm. But gold eagles today are not the money of the realm. Gold eagles are sold to the public by the mint. And they really turn around and say, oh, well, we sold it to you, but you can't have it. So as far as a confiscation of gold is concerned, your safest holding as an American would be a pre-33 gold. The next safest would be eagles. And on the topic of confiscation, the U.S. and Canada are considered the safest havens for mining projects. And I would suggest that if we do go through a confiscation, I am not so sure they're going to confiscate the individual coins. I think what they'll do is they'll nationalize the mines because that's the raw supply and there's more of it. Yeah, that's a plan, but the problem with that is how do you transact with it? How do you offload it at a later date? You obviously got to test for purity. I don't see them going door to door because you'd have in the first day several shootouts and deaths. So I don't see them going door to door. I don't think there's any need to melt down perfectly good gold coins into jewelry because I don't think jewelry is not going to function. It won't work from a trade standpoint because the other side doesn't know how much gold is in that piece of jewelry.
While the outlook for silver is highly optimistic, it is essential to consider the potential risks and challenges associated with investing in this precious metal. Understanding these risks will help you make more informed investment decisions and manage your portfolio effectively. One of the primary risks is market volatility. Silver prices are known for their volatility, often experiencing significant price swings in short periods. This volatility can be driven by various factors, including changes in investor sentiment, geopolitical events, and economic data releases. Investors should be prepared for potential price fluctuations and consider their risk tolerance before investing heavily in silver. Another consideration is the potential for market manipulation. Historically, the silver market has been subject to manipulation by large financial institutions through the use of paper contracts and futures. While the physical market is beginning to assert more influence, the possibility of manipulation remains. Regulatory changes and increased transparency in the market could mitigate this risk, but it is something investors should keep in mind. Liquidity is also a factor to consider. While silver is a highly liquid asset compared to many other investments, there can be periods of reduced liquidity, particularly in the physical market. This can make it more challenging to buy or sell silver at desired prices, especially during times of market stress. Ensuring that you have access to reputable dealers and markets can help alleviate some of these concerns. Storage and security are practical considerations for investors holding physical silver. Unlike paper assets, physical silver requires secure storage to protect it from theft and damage. This can incur additional costs, such as purchasing a safe or paying for secure storage facilities. Additionally, investors should consider the insurance costs associated with safeguarding their silver holdings. Economic factors, such as changes in interest rates and monetary policy, can also impact silver prices. For instance, if central banks decide to tighten monetary policy and raise interest rates, it could strengthen fiat currencies and reduce the appeal of precious metals as a hedge against inflation. Keeping an eye on macroeconomic trends and central bank policies is crucial for silver investors. Another risk is the potential for technological advancements that could reduce the demand for silver. While silver is currently irreplaceable in many industrial applications, future technological innovations could find alternatives to silver, potentially reducing its industrial demand. Staying informed about technological trends and advancements in the industries that consume silver can help investors anticipate and adapt to these changes. Tax considerations are also important for silver investors. The tax treatment of silver investments can vary significantly depending on your country of residence and the type of investment: physical silver, ETFs, mining stocks, etc. Consulting with a tax professional can help you understand the tax implications of your silver investments and optimize your strategy accordingly. Finally, geopolitical risks and changes in government policies can affect silver prices. Trade policies, tariffs, and international relations can influence the demand and supply dynamics of silver. Investors should stay informed about global political developments and consider how they might impact the silver market. Despite these risks, the long-term outlook for silver remains highly favorable, supported by strong industrial demand, economic uncertainty, and the potential for currency devaluation. By understanding and managing these risks, investors can position themselves to benefit from the potential upside in silver prices while mitigating potential downsides. As we approach the conclusion of our exploration into the future of silver, it's clear that while there are risks, the potential rewards make silver an attractive investment. Stay with us as we reach the apex of our discussion, where we will summarize the key points and explain exactly how Bill Holter's prediction of a $3,000 silver price could become a reality.
The center of the financial world for years and years has been New York and been London. And you've got the COMEX in New York, you've got the LME in London, and those paper contracts are what, for years and years, have priced the metal. Fast forward to where we are now, and what you've got is a premium of $2 to $3 in silver and $30 to $50 or more in gold, Shanghai over the Western prices. So what's happening is you're getting buying in the West, demanding delivery, and then that metal gets shipped to China, and it's an automatic. You're locking in a profit as soon as you buy the metal. You buy the metal, you sell the metal at the same time, then you deliver it, and you book the profit. So metal is being bled from west to east. And if you're a student of history at all, power flows with money, and money is gold.
We've explored the current rally in precious metals, delved into historical contexts, examined economic factors, and analyzed expert opinions and potential risks. Now it's time to bring it all together and explain how Bill Holter's bold prediction of a $3,000 silver price could indeed become a reality. The confluence of several powerful factors is setting the stage for a monumental rise in silver prices. Firstly, the ongoing economic uncertainty and inflation fears are driving investors to seek refuge in safe haven assets. The expansive monetary policies adopted by central banks worldwide, particularly in response to the COVID-19 pandemic, have significantly increased the money supply. This has led to rising inflation rates, reducing the purchasing power of fiat currencies, and pushing investors towards tangible assets like silver. Secondly, the demand from emerging markets is playing a crucial role. Countries like China and India are not only increasing their silver imports for industrial purposes, but also as a hedge against economic instability. The rapid expansion of industries such as solar energy and electric vehicles in these countries is driving a substantial increase in silver consumption. Thirdly, the technological and industrial uses of silver are expanding. Silver's unparalleled conductive properties make it indispensable in electronics, medical applications, and green technologies. As these industries grow, so does the demand for silver, further tightening the supply. The physical silver market's growing dominance over the paper market is another critical factor. Physical silver demand is increasingly outweighing the influence of paper contracts and futures, reducing the potential for market manipulation and driving prices higher. This shift is particularly evident in the premium seen in physical silver markets compared to paper silver prices. Additionally, expert opinions from renowned analysts like Mike Maloney, David Morgan, and Rick Rule align with Bill Holter's bullish outlook. They highlight the strong fundamentals supporting silver's future appreciation. From its historical performance during economic crises to its critical role in emerging technologies and industrial applications. However, it's essential to recognize the risks and manage them effectively. Market volatility, potential manipulation, and storage costs are some of the challenges investors must navigate. By staying informed and diversifying their portfolios, investors can mitigate these risks and position themselves to benefit from silver's potential rise. Bill Holter's prediction of a $3,000 silver price is grounded in a comprehensive analysis of these factors. As confidence in fiat currencies continues to erode and inflationary pressures mount, silver's appeal as a store of value and a hedge against economic instability is set to grow. The physical demand from emerging markets and technological advancements will further support this trend, driving prices higher. In conclusion, the current rally in precious metals is just the beginning. The unique combination of economic, industrial, and market dynamics creates a compelling case for a significant increase in silver prices. As we navigate these uncertain times, integrating silver into your investment strategy could provide substantial benefits and safeguard your wealth. Thank you for joining us on this journey through the future of silver. Don't forget to
Gold is going to end up in dollar terms or euros or yen or whatever, many, many, many multiples higher than it is right now. Time-wise, I think this whole event could be over in, who knows, 2 years, 3 years, 5 years. If you go back and you look at the Weimar Republic, gold was 170 Reichmarks per ounce in 1918 or 1919. By 1923, it was however many trillion Reichmark. And that's a function of the currency going to zero. And that's where mathematically all of these debt currencies are going to end up. They're all going to go to zero. So I guess the way to look at it is gold, silver, a cup of coffee, a gallon of gas, a dozen eggs. They're all going to be unobtainable at some point with dollars, because dollars just simply won't be accepted. The whole idea behind gold and silver is that they cannot bankrupt. And by taking capital out of, quote, the system and putting it into gold and silver, you're out of the system. So when that system fails, you still have however many ounces of gold, however many ounces of silver. It's basically, and this goes back to my business partner's, Jim Sinclair's terms, GOTS, get out of the system. And the reason to get out of the system, and he was, 20 years ahead of time. He started talking about this in 2003, 2004. Here we are 20 years later, and late last year, early this year, if you've not read or watched the video on the Great Taking, you need to do that, because everything that's in the system is going to be stolen. And this is not speculation. These laws are on the books. They would not have put these laws on the books unless they were going to use them. And the bottom line is, okay, so you've got 5 million or 10 million or 50,000 or whatever you have with your broker. Those stocks are not in your name. They're not your stocks. They're owned by the broker for your benefit. When the broker goes down, they're going to take the whole pool of what they're holding, and they're going to use that to keep themselves solvent. And that is legal. Same thing with banks. Banks are going to bail your account in. You're not going to be bailed out.